port opens with a dramatic declaration that the long-anticipated alignment of global currencies has moved beyond theory and rumor into real-time execution. The Iraqi Dinar and the Vietnamese Dong, two currencies long surrounded by speculation about their potential revaluation, presented as the focal point of a sweeping international banking rollout. Major institutions across the United States, including Wells Fargo, Chase, Bank of America, Citibank, are confirmed as active participants, leveraging both their domestic infrastructure and extensive global reach. Alongside them, PN financial powerhouses such as HSBC, Barclays, Deutsche Bank, and BNP Paribas have synchronized their systems, while Asian giants including ICBC, UFG, DBS are reported to be fully integrated. The Middle East, with its oil-backed liquidity and long-standing role in energy markets, is represented by Emirates MBD and Al Rajhi, while Africa and Latin America are not excluded, with banks like Ecobank and Banco do Brazil taking their place in this coalition. The narrative stresses that this alignment is not an isolated experiment or a limited regional trial, but the first truly coordinated global activation of its kind. What makes it remarkable is the scale of the cooperation across 48 nations, cutting through traditional geopolitical divides and regulatory bottlenecks. Insiders trace the origins of this movement back to August 2025, when unusual activity was first observed within private financial networks. At the time, these movements were thought to be nothing more than stress tests or small pilots designed to probe the resiliency of digital settlement systems under speculative pressure. As more details emerged, it became clear that what was unfolding was far larger, carefully choreographed synchronization of liquidity flows and back-end banking infrastructure. These operations were conducted under strict non-disclosure agreements, leaving only a trail of whispers among those who were closest to the corridors of treasury departments and central banks. By early September, those whispers hardened into confirmation. Reports circulated that treasury departments on multiple continents had received operational green lights, effectively authorizing them to connect sovereign settlement nodes across borders, unlike previous efforts where delays and fragmented rollouts were common. This wave of permissions appeared to be granted almost simultaneously, allowing sovereign monetary systems to link into a unified digital framework. Efficiency of this execution defied normal expectations, where regulatory hurdles often stretch out for months or even years. Coordinated approvals suggested not only urgency, but also a level of political and institutional alignment that had been absent in earlier attempts at financial synchronization. As the process advanced, analysts began framing the significance of the event not merely as technical coordination, but as a philosophical transformation in how global liquidity would be managed going forward. It was no longer about piecemeal reforms in countries like Iraq or Vietnam, but about a systemic reset that recalibrated value flows across continents. And banks involved were not simply adjusting their local infrastructure, but were participating in a monumental restructuring of the global financial grid, one that replaced fragmentation with integration and speculation with operational reality. This was described as a turning point where private and sovereign interests intersected in a new architecture of finance that reached or beyond FARD, currency, broader distribution of global the copying of global wealth. The confirmation for the catalyst for what many had long suspected, but few actually witnessed. Cascading sequence of events that pushed the revaluation narrative from speculative chatter into concrete execution. Reports from banking insiders began to surface indicating that test transactions were no longer confined to internal simulations, but were being carried out with lev funds across multiple jurisdictions. These transfers were small in volume, yet significant in implication, representing proof that the infrastructure linking the Dinar-Dong, other associated currencies to the global settlement grid was functioning in real time. For those following the story closely, this was the signal that the system was not only switched on, but was actively processing data, marking a profound departure from previous cycles of rumor where claims of activation were unsupported by verifiable activity. With this operational clarity came the emergence of redemption centers, concept that had circulated for years in speculative circles, but had never been verified with such specificity. Large metropolitan hubs became the first focal points. Banks discreetly prepared facilities separate from traditional retail branches. These centers were outfitted with secure access, biometric verification tools, private consultation spaces designed to handle the sensitive nature of currency exchanges under strict confidentiality. Reports indicated that these locations were not makeshift arrangements, but permanent installations integrated into the broader financial infrastructure, capable of scaling rapidly as demand increased. Their existence suggested that the revaluation was not envisioned as a brief window of activity, but as an enduring process with the capacity to manage waves of participants over time. Same time, non-disclosure agreements began surfacing as an unavoidable feature of the rollout, reinforcing the notion that what was taking place was carefully controlled and deliberately shielded from premature exposure. Participants were reportedly required to sign NDAs before accessing higher contractual rates or participating in structured payout programs, effectively binding them to silence about the specifics of their transactions. This mechanism created both intrigue and tension, as it underscored the seriousness of the process while simultaneously fueling speculation among those who had not yet received invitations or appointments. The layered nature of these agreements implied that the rollout was being segmented across tiers, early participants bound by stricter terms, while broader public access would come later with looser restrictions. As this dynamic unfolded, the role of the major banks became even more pronounced. Institutions like Wells Fargo and HSBC were not simply processing transactions, but were acting as gatekeepers of information, controlling the flow of access codes, instructions, and scheduling details. This centralized management allowed for a smoother sequencing of events, reducing the risk of overcrowding or leaks that could destabilize the process. It's noted that this level of control was only possible because of the years of preparation and coordination behind the scenes. Systems had been stress tested and security protocols refined to withstand scrutiny from both participants and regulators. Regions. The measured pace and disciplined communication strategy gave the impression of a rollout design disruption while maximizing confidence in the legitimacy of the process. The sequence of the rollout was outlined with precise stages that gave participants a sense of order rarely seen in pre-national financial events. It began with back-end activations on September 14th and 15th, when the cross-border settlement grid linking 48 nations was confirmed to be fully operational. This stage was critical because it established the technical foundation that would support every subsequent transaction, ensuring that the system was live before any public-facing movement could occur. By the time whispers reached investors and insiders, The infrastructure had already been tested and stabilized, eliminating the uncertainty that often accompanies large-scale financial transitions. From September 16th through the 18th, the rollout entered the Tier 4B phase, where select pre-registered participants were contacted in major U.S. metropolitan centers. Notifications were sent out containing secure access codes, maps to redemption centers, and appointment windows. Cities such as New York, Dallas, Los Angeles, Miami were among the first to be activated. Ports described participants being ushered into discrete facilities designed for high security financial transactions. These locations were prepared with biometric systems, private consultation rooms, and non-disclosure agreements that reinforced the confidentiality of the process. Following stage, marked for September 19th to 22nd, centered on the signing of NDAs and the commencement of structured payout programs. This was the point at which the revaluation began to take shape, not only as a technical achievement, but as a contractual and financial reality for those participating. The structured payouts were designed to ensure controlled liquidity release while safeguarding against market destabilization. This method allowed participants to access significant funds while also ensuring that the broader financial system could absorb the transition without triggering volatility across regional or global markets.